Good afternoon, and thank you for joining us. Welcome to the latest installment of GreenCrest's monthly webinar series on the digital media, social media, and e-commerce sector. Today we're going to be discussing the mobile advertising environment. There's been a lot of talk about mobile ads as the next leg up for the ad market and for digital media companies in general. But there's also been a lot of concerns around how exactly this opportunity is going to be evolving. So questions around ad inventory, around pricing, around competition, around whether brands are seeing the value, all these kind of questions are coming up. So today we want to ask the very big question as to whether mobile advertising is a screen dream, i.e. will it be a true growth driver of advertising, or is it a smokescreen? In other words, once you get behind all the layers, is there any real opportunity there for true growth? So that's a question that we're going to be answering today. So again, thank you very much. We're going to be going through some prepared comments, and at the end of it, we'll take some questions. On this slide, as you can see, we have our disclaimer. So please feel free to take a read through it, and it is available upon request for everyone that wants it. Here we're looking at today's discussion. The presenter is myself, Anupam Palit. I am a senior analyst, and I lead our research efforts here at GreenCrest. Today we're going to be talking about the mobile ad environment, as I mentioned. So we're going to take a look at the high level and the overall trends taking place in the ad market at large. We're going to be looking at three parts of it. So, on the intro slide, we talked a little bit about, we showed a little graphic showing some brands, and an arrow pointing to networks, and then that arrow pointing to publishers. So the idea is that brands are going to go through networks to publish their ads on publishers. So we'll take a quick look at each of those. We'll talk about brands. We'll talk about how we do expect the spending to rise, although there is a lot of caution in the space. We're going to look at some ad networks and look at some of the interesting market share shifts that are taking place. And we'll look at some publishers and come to the conclusion that not everyone is a winner when it comes to mobile advertising. So these are some of the topics that we're going to explore. So again, my name is Anupam Palit. I lead our research effort here at GreenCrest Capital. GreenCrest focuses on private companies. That is really our area of expertise. We look at private companies in a bunch of different subsectors in the TMT space, and that includes e-commerce, social media, digital media, online advertising, and so a number of different companies in this space. And we hold these monthly webinars to speak to people and give our thoughts and to take questions and to initiate conversations with people. So again, thank you very much for joining us. We're going to have some prepared comments on the mobile ad space. At the end of it, we'll take any questions, and then we'll get to as many as we have time for. In your box on the webinar, in your display box, there's an opportunity there to type in some questions. So please don't feel that you have to wait till the end. Type in some questions as we go through. We'll be queuing the questions throughout the presentation, and at the end of it, we'll get to as many as we can. So again, thanks a lot, and let's talk about the overall ad environment. So as we can see on this slide, the main thing behind mobile advertising is ultimately smartphone penetration. The basic driver of all this is the growth in the usage of web-connected, application-capable, advanced handsets. And we kind of use the word smartphone as a general term for these devices. The idea is that we're moving away from feature phones, which are primarily used for voice and text only, to real smartphones. So we have the web with us anywhere we want to go. Our screens are optimized to have very advanced applications. We have very advanced types of communication. We're not just using text, and we're not just making phone calls. It's a much more visual, advanced, local experience for the mobile phone. And as that increases, the opportunities for advertising increase as well. So according to eMarketer, we're looking at about 1/3 or so penetration, rising to nearly 40% next year. In terms of smartphone penetration, and over the next 4 years, we expect about 2/3 or so of the U.S. Phone market to be smartphones, in fact. So this is really going to be the core driver of the overall opportunity from a very high-level point of view. Let's take a look at the actual ad market. According to IDC, it was nearly $900 million in 2010, growing to $2.1 billion in 2011. And they expect $4.1 billion of mobile ad spend in 2012. So the growth expectation here is very strong. The majority of this ad spend right now is in the search category. So about two-thirds of mobile ads are search-based, and this category is perhaps no surprise is dominated by Google. The rest is display advertising, so the remaining third, and that is a lot more fragmented. We're actually going to get to that a little bit later. So as we mentioned, we're going to be talking about brands, networks, and publishers. So now that we've kind of set the stage for what the environment looks like, let's take a couple of minutes and talk about brands. What we want to do first is kind of ask the question, what are brands looking for in terms of mobile ads? What are they trying to accomplish? And we looked at a very detailed study conducted by Ovum, and this study looked at how brands think about mobile advertising. The survey looked at companies across different sizes, industries, and stages in their mobile evolution. So again, for this slide, what we're trying to do is ask, what are brands looking for? So we looked at the key benefits of mobile advertising according to brands. And these percentages are the percentages of the companies that said that the following categories were of high importance to them. So as we can see, some of the big ones are immediacy, cost, engagement, and reach, each of which are about half or more than half answered that is very important to them. We see things like location-based capabilities, targeting, interactive capabilities. Around 40% or so companies said that these were of interest to them and very important to them. Then we see things like response rates and the fact that these mobile ad campaigns can be complementary to their existing campaigns. That's about important to about a third of them. So really, all of these things are very, very important to them, and all of these make intuitive sense, especially when it comes to immediacy, engagement, and location-based. Obviously, when we're thinking about mobile devices and the fact that they can be GPS enabled, the fact that people are often looking for whether it's content or services or products in the area where they are physically at that moment, that really speaks to the fact that immediacy, engagement, and location-based can be served along the lines of a mobile platform. So once we've kind of talked about what brands are looking for in terms of mobile ads, what the benefits that they see, the next logical step is to see if they're actually getting what they're looking for. So let's talk about a couple of the challenges that brands are seeing right now. On this slide, again, we took the same kind of approach. These are the key challenges of mobile advertising as indicated by brands. And again, the percentage of companies, this is the percent of companies that said that these are of high importance to them. We see right away on the left side of the screen, the biggest bar here is privacy. And we know that in particular, privacy has been on the forefront of the overall mobile discussion. We don't expect this issue to be resolved anytime in the near future. The privacy debate will rage on. And and not to be glib about this, but most likely into eternity. In other words, there's going to be a constant battle back and forth between privacy advocates, users, advertisers, and the mobile social ecosystem at large. So we don't see an end to this debate. It's going to be kind of a constantly evolving debate, and a debate that kind of goes on, into infinity, so to speak. We saw one development a couple of weeks back. The California Attorney General, Kamala Harris, struck a deal. Privacy deal with Apple, Google, Amazon, Microsoft, and Research in Motion, so i.e. all the big operating systems, and that outlined the need for mobile apps to clearly indicate when they were collecting user data. So again, another kind of step towards understanding a little bit more about what's happening with privacy. So the reason this is so important is that obviously, privacy is a big issue. People are spending more of their time online. People are spending more of their time on mobile platforms. And what's happening is these platforms and these services are taking user data and packaging them in different ways and selling them to advertisers. So it has to be this way, first of all, because as our chief economist, Max Wolf, always likes to say, if you're not paying for the product, then you are the product. In other words, if you're not paying some kind of a subscription fee or something to join the platform, whatever that platform is, you are the product. In other words, your information is what is being sold to advertisers, and that's how these platforms are paying the bills, so to speak. So it's very important that we think about privacy. So again, when it comes to privacy and collecting of user data, this is going to be an ongoing debate. We've also got other things that brands are concerned about. Operating system fragmentation is very significant. So again, we're thinking about how iPhones and iPads use iOS as their operating system. We're seeing a growing proportion of phones using the Android system. So your HTCs and your Samsungs and your Motorola's are using Android platforms. We've got Research in Motion, which has its own operating system, which is slowly, or I guess you could say it's rapidly declining. But now we're seeing the rise of Windows Phone 7 with Nokia being the first big handset that is going to be starting using the Windows Phone. So this fragmentation is of concern to people. We've also got issues with standardization, so metrics and formats, trying to figure out what the right way to think about pricing and inventory are. And then we're getting to agency expertise and lack of creativity. This is mostly kind of logistical issues in the sense that you're dealing with a small screen often. Your desktop versus your iPhone, for example. Your iPhone is a smaller screen. There's less room to simply find or to look at content or a service and mix that in with some kind of an advertisement. And because you don't often get the speeds you get mobilely versus the desktop, you're talking about not the same type of creativity when it comes to designing advertisements. And of course, 15% of brands are concerned with inventory. So just how should we think about inventory? Is there enough inventory? Is there too much inventory? Who's getting what? Where can I get it? These are all kind of logistical questions. So all of these things impact the broader demand for mobile advertising. So, when we think about the benefits, we think about all the challenges, the next question we have to ask ourselves is, okay, given what we've talked about in terms of benefits and challenges, how satisfied are brands right now with their mobile experience? And unfortunately, we have to say that as of right now, the data is not particularly positive overall. So the Ovum study asked brands, what is your level of satisfaction with certain types of campaigns that you're driving or for certain goals that you're trying to meet? And so this is a percentage of companies that said they were completely satisfied, with what's happening right now in terms of these types of needs that they have. And so overall, it looks like brands are not really seeing the value. So these are kind of the top categories of complete satisfaction, believe it or not. So the top category for complete satisfaction was only 10%. So only 10% of firms are seeing the benefits on specific promotions. Only 9% are completely satisfied with mobile advertising as it helps them in terms of brand awareness and customer relationship management. And only 8% of firms in this survey felt that they were completely satisfied with what they were getting in terms of engagement and driving sales. And so we're not talking about particularly big numbers here. I would actually say that these were probably well below our expectations. You could categorize them as being a little bit dissatisfying. In particular, at GreenCrest, we're concerned about the low engagement number, because here at GreenCrest, we focus quite a bit on social media, and engagement is really the key promise of social media. So overall, when we think about this, we definitely need to see these numbers go up over time. Otherwise, the overall value proposition just isn't there. So we need to see improvement in these numbers. And incidentally, we do think we will. But this just gives you a sense of the lay of the land where we are right now in terms of the overall satisfaction level. Now that we've kind of gone over the bad news, let's go over the good news. There is a very bright silver lining to this proverbial dark cloud, and we'll see it on the next slide. What we see here is the relative budget allocations for mobile advertising, and I think overall the data here is actually very positive. So let's actually start on the right side of the screen and just look at who's changing their budgets and who's not changing their budgets before we ask ourselves where the budgets are going. So we can see that only about a quarter of brands are looking to change their budget, or to leave their budgets unchanged, I should say, over the next 2 years. This is nearly 40% of brands were actually looking to leave their budgets or did not change their budgets over the last 2 years. So the gray bars are the last 2 years, the greens are the next 2 years, and we're seeing that less companies are leaving their budgets unchanged. So they're changing. So the question is, are they going up or are they going down, of course? And on the left side, if we start on the left side of the screen, we can see that overall budgets appear to be going up in terms of budget allocations for mobile advertising. So the number of brands that are looking to increase their budget by more than 50% over the next 2 years is 35%. We think it's a very healthy number, and it compares to 29% of brands that increased their budget by more than 50% in the last 2 years. So, a 600 basis point increase there. So that's a very healthy number. In terms of people who are looking to increase their budget by less than 50%, but still an increase, that number is also going up. So 37% of companies are looking to increase their budget by less than 50%, but still an increase over the next 2 years. And that's a 300 basis point improvement than this category in the last 2 years. We see a decrease in budget about 1%. That is, you get some statistical anomalies. You always get a couple of people who are going to reduce their budget. We don't think the 1% is particularly meaningful in the overall context. It's obviously a very small number. But overall, I think that we're seeing data to clearly support the fact that overall ad budgets are going to be going up with respect to allocating for mobile ad spending. So now that we talked about brands, let's move on to the ad networks. So there's a couple of very interesting things happening here, as we can see. In an earlier slide, we outlined the split between search and display when it came to mobile advertising. So we talked about a third of the market being display and about 2/3 of it being on the search side. The search side, as we talked about, is mostly dominated by Google right now. So we actually, let's take a look at the breakdown of the U.S. display market. And what we can see is that AdMob, which is actually owned by Google, accounts for about a quarter or so of the marketplace right now. So Google does have a dominant position in U.S. display on the mobile platforms, but not to the same extent that it does on the search side. In second place here, in terms of the overall U.S. mobile display market, is millennial media, 17%, and the third place is iAd, which is Apple's platform. And then we get into some of the smaller players like JumpTap, Yahoo, Microsoft, and about 20% of them are from other categories. What we can see is that there has been some market share shift that's taking place, and we see this on the right side of the screen in terms of the bar graph. AdMob, so Google's product, has actually improved market share from 19% to 24%. By the same token, we've seen millennial media actually improve its market share from 15% to 17%. This is 2010 versus 2011. Unfortunately, for Apple, iAd has actually seen its market share decrease from 19% to 15% year over year. So that's a 400 basis point decline from 2010 to 2011. So that's been a little bit interesting for them. So what are the implications of this? First of all, AdMob is doing very, very well, and I think this bodes well for Google overall. Not just for mobile advertising, but in a general perspective. So when we think about what Google does, what it's doing a lot of right now is building and growing inorganically. So when you think about what they did with YouTube at the time that they acquired YouTube, people were saying that they overpaid for it. Now YouTube is a huge driver. A lot of those same questions were around AdMob. And a lot of those same questions were around kind of different products that is happening right now with Motorola Mobility. So people are asking a lot of these kinds of questions. But I think the success that we've seen, certainly with YouTube, certainly with AdMob, kind of goes to show that Google invests in these properties after it acquires them. And there's a real opportunity for growth here. The second implication, I think, for millennial media seeing a percentage increase bodes very well. Millennial media has filed an S1. They are looking to go public over the next couple of months. And I think that this kind of a market share increase is very good for them, certainly ahead of an IPO. So there's a lot of momentum going into their business ahead of their IPO. So that's a very good sign for them. For Apple, it's forced them to kind of rethink their strategy. So that they've actually made a number of changes. The minimum iAd commitment used to be $1 million. It then declined to $500,000 late last year. And recently, it looks like it's come down to about $400,000. So what's happening right now is that you're seeing a lot of kind of pricing commitment come down. So that's very significant. The CPM on average for iAd campaigns is about $10. That compares to AdMob in the $4 to $12 range, so they're kind of in the middle of that range. But in general, when you think about overall average, AdMob tends to be in the $4 to $6 range, so a bit cheaper than iAd. Some of the premium inventory is going to go for a higher price, but AdMob overall tends to be at a lower price. Apple's also been giving more of the share to developers. So the share to developers actually increased recently from 60% to 70%. The 70%, of course, being in line with kind of the old split that tends to happen for Apple, the 70-30 split that is typical for most of their monetization mechanisms. But that is an increase from the 60%. So all of these things are very important, and it could help Apple reclaim some market share. But of course, one of the biggest problems with Apple is that, of course, iAd only supports the iOS platform. So when you think about some of the other competitors that will allow you to spread your advertising across multiple devices, you only kind of get one set of devices, one set of platforms with your iAd spend. So it'll be interesting to see if Apple can kind of turn around the declining momentum that it's seen in its overall market share. With that, let's move to the publishers. So there are a lot of companies that are seeing opportunities in mobile advertising, right? So in terms of where you actually see the ad, and we're thinking about here where you see the ad, and the idea is that in mobile advertising there are there's a few companies, many companies, but there's a few that we mentioned here that I think there's a big opportunity for them. So we start with Zynga. They're beginning to aggressively monetize mobile ads through new game development. They do have a rapidly growing mobile ad base. You're talking about 15 million mobile daily active users. They have a pretty active mobile pipeline for 2012. So, I think that bodes very well for them. Now, certainly when you think about in-app purchases versus mobile advertising or advertising in general at Zynga, in-app purchases are going to be the bigger player here for long term. The games with in-app purchases tend to monetize at a higher rate than advertising, but advertising is very, very key to the games, especially on the mobile platform. And what's happening, Zynga has actually uncovered some very unique ways to do advertising, of course, which that is not just a standard display ad all the time. You can incorporate different brands within the games as you're using them. So you can have your Cityville, and when you build your coffee shop in Cityville, it can actually be a Starbucks coffee shop, for example. So different unique ways to implement to advertising there. Facebook, of course, it's very early on in its mobile ad development life cycle. It does not currently directly generate meaningful revenue from the use of Facebook mobile products, as from the S1, but the opportunity for them is very substantial. 425 million mobile monthly active users, and they've begun to take the first steps a little bit in order to start thinking about how to monetize better on the mobile platforms. So again, very early on, but there's an enormous opportunity for them as time goes on. We've also seen some movement by Hearst Corporation. Hearst, more of a traditional publisher, moving in to the online space and certainly into the mobile space now. And you're seeing very aggressively seeking monetization opportunities through mobile display ads, barcode-driven promotions, embedded apps. So Hearst is one of those real success stories when it comes to being able to monetize mobile advertising. So, these are three examples, but there's a lot of examples of companies that are certainly making, a lot of headway in this space, in the mobile advertising space, and there's a lot of upside opportunity for many other companies. Unfortunately, we don't think everyone's a winner in the space when it comes to mobile advertising. We do think there are some losers in the space, and I think that Pandora, unfortunately, is an example of a company that's going to have trouble and has had trouble monetizing advertising. So when we think about this particular opportunity, we look at the mobile versus desktop hours and the associated amount of revenue. So we see the listener hours, about 70% or so are on the mobile platform, but only about 50% of the ad revenue. And so you can see on the right side that the average revenue per hour on mobile is actually substantially lower than it is on desktop. And so, when you think about the revenue per hour on mobile being lower than desktop, perhaps that's not as concerning in a world where maybe 10, 15% of your hours are mobile. But in a world where that has now transitioned from 10, 15% a couple of years ago to 70%, then it's a real problem because more and more of your hours are going to the low revenue base. In fact, last night, when Pandora reported their quarter, we saw this unfold. This has been our thesis since the company went public, and I think we saw some of that unfold last night, which is that, in fact, the management team indicated that listener hours have actually increased a little bit beyond the 70%, and mobile continues to be very difficult for them to monetize. Um, we think this is basically a fundamental problem with the business, something that they're going to have to overcome over time. And the reason we think that is that unlike some other things like the digital games or something like a social network like Facebook or something that's very heavily visually content-driven like Hearst, what's happening is that Pandora is primarily an audio experience. So more and more what's happening is that people will listen to Pandora on their mobile device and literally put the device in their pocket. They're not actually looking at the device. And so what we're seeing is that brands are not willing to pay for visual type advertising, which obviously monetizes at a higher rate than audio only advertising. In fact, the management team last night indicated in their prepared comments, or actually in answer to a question, that almost all of the ads that they sell on mobile are basically audio ads. They're not visual ads. And that's part of the reason this dynamic that we're seeing on this page. That's part of the reason why you see Pandora stock, lose about a quarter of its market value today. We saw that in the results last night, that this dynamic is playing out, and it's going to be very, very difficult for them to overcome. So here are kind of key takeaways for the day, and we think that IDC's 2012 forecast for mobile ad spend is achievable, but we think it's likely to be the upper bound of where ad spend comes in. One thing that's really going to help a lot is the growing tablet penetration, and that's really going to be a key to long-term growth profile. So what's really happening is that for the first time we're seeing, with respect to with tablets, what we're really seeing is that for the first time we're seeing the true online experience being replicated for light mobile devices. We had this a couple of years ago when we thought it was going to be netbooks. When netbooks first came out, they were all the rage. It turns out they weren't as powerful as we thought they were going to be. They didn't function as well. Return rates on netbooks were actually skyrocketed within the first couple of months. They were still a little bit clunky despite the fact that they were extremely light. And they just didn't work as well. The Microsoft Office products didn't work as well. The internet browsing was a little bit slow. So overall, it wasn't a great experience. What we're seeing now with tablets is that this is the first time we've been able to really replicate the full online experience as close as we can get onto light mobile devices. Of course, that also means that the screen size is a little bit larger, so you can actually have a piece of content that you're reading or watching a video, listening to Pandora, and actually have some type of display advertising built into that experience without kind of really limiting your experience. You can view your content and have the advertisement there at the same time. So tablet penetration is going to be very key to long-term growth in this space. Long-term growth is also going to be contingent on having more standardized metrics and formats, and this is going to happen over time. And as you think about how it's going to be monetized, what the formats are going to be, what the inventory is going to look like, this is something that is going to evolve over time as this market evolves. The device and operating system fragmentation, unfortunately, is the reality. It's unlikely to be resolved. If anything, it's going to get more and more divisive, so to speak, as Windows Phone 7 starts to make more and more headway, and Nokia begins to implement Windows Phone 7. You are seeing, three very big players in the space: Android, of course, iOS, of course, and Windows Phone 7 being the third one, with BlackBerry share rapidly declining. And of course, Nokia's old operating system basically being phased out. So, these are the kind of big ones in the space. And what we saw was that we saw a rapid rise in overall Android penetration in the marketplace. And a lot of people are saying, well, this is basically it. Android is going to dominate the marketplace for a long time. But with the introduction of the iPhone, with the latest iPhone that we saw a couple of months ago, we saw fourth quarter market share shift around quite a bit, and iOS made quite the comeback. So I think what's going to happen long term is as new products, as new exciting phones, as new tablets come to the marketplace, these market shares are going to jump around quite a bit. The long-term view that we have here is that it's going to be very much a fragmented market over the long period of time. And finally, we think that Google will continue to dominate search and will continue to be the share leader in mobile for the foreseeable future. Certainly, we don't see any big movements in search taking place anytime over the next little while. On the display side, we expect AdMob to retain its market share, but we do think that that could shift if Apple can resolve its pricing and its device limitation. By device limitation, I don't mean to say that iPhones are limited in any way. What I mean to say is that iOS is kind of reserved for, or iAd is reserved for kind of iOS products. So, um, Apple has made a lot of changes to the pricing, and it remains to be seen whether they can kind of claw back any of that 400 basis point market share that they've lost. So those are our key takeaways for the day. Before we turn over to Q&A, I do want to take one moment and thank you again for joining us. We are going to go to questions in a couple of seconds, but I just want to give some content information. Our website is there. You can follow us at GreenCrest Cap on Twitter. You can also follow me on Twitter. Our email, phone number, everything is there. So what we really want to do is, and this is our aim for all these webinars, is not to, speak to you once a month for a half an hour, whatever it may be. For many of you, we speak to you on a fairly regular basis. And what we're trying to do is initiate a conversation through these webinars. We want you to stay in touch, and if you ever have follow-up questions or talk to us about this or give us ideas for future webinars, we're always open to ideas, and we always want to talk to people. So with that, I'm going to stop my formal comments, and I'll open up for Q&A. So what we'll do now is we've seen some questions building in the queue. We'll give you guys a chance to enter some more questions. We're going to take about 15 or 20 seconds here and just queue up the questions, and then we'll answer them in a couple seconds. So just bear with us for a couple seconds here. All right, great. So let's get to a couple of your questions. We have here, this is an interesting question actually. What is the expected long-term mix of display versus search advertising on mobile? It's actually a really interesting question. So what we're seeing right now is that display happens to be um, 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 1/3 or so. Display is about 1/3 of the overall mobile ad environment. And search is about 2/3 of overall. So over time, what we think is going to happen is display is going to grow because we're going to get some better, this goes back to kind of the standardization, around metrics and the standardization around kind of, ways of measurement. So I think that what's happening is that we are going to see display grow as a proportion. And over time, we think it's going to reach where the overall online revenue split is. So right now, when you look at overall online revenues, and not just mobile, but overall, it's about 50% search, with the rest kind of split, the rest kind of this overall category that we tend to call display. And that includes kind of banners, videos, rich media, et cetera, et cetera. So over time, we do think display is going to increase its proportion and its contribution to overall mobile spend. And we think that over time, we could see a closer to 50-50 split on the mobile side of things, just as we do on the overall online display side of things. Let's see. Okay, why is engagement so important to social media? That's actually a very good question. So when we, I mentioned this, I guess as a response to my comment a few minutes ago, that I was saying that we at GreenCrest focus quite a bit on the engagement measure because that's really the promise of social media. The idea here is that it's so important because when you think about how advertising has kind of trended over time and the different kinds of formats that we have and the ways to monetize, we're going through a shift right now and brands are determining whether engagement is something that they're going to pay for. So in kind of the first idea around advertising on the internet was kind of big banner ads, and you pay for those on an impression basis, kind of a CPM-based advertising. And CPM-based advertising still has a very important role to play in the overall ad market. But I think that we're seeing is that what happens to brands that they say we want more than just we want to pay for more than just somebody viewing our ad or the fact that the ad was served. We need some kind of an action, and the action on the online world, of course, was the click. So then we moved into kind of cost per click advertising. So you do CPM-based advertising, you do cost per click-based advertising, but now brands are asking for something more. We don't want just someone to see our ad. We don't want just someone to click on our ad. We want a true engagement. And this is where social media comes in, because you can actually make some kind of a qualitative commentary on the brand. And I'm going to mix this in with the second question that we have, because there's a question here about Twitter and Facebook engagement and what that means for Twitter revenues and Facebook revenues. So let me just finish this point and kind of lead into that, which is that the idea of engagement here is that you're saying something about the brand. You're interacting with the brand, and the brand gets to interact with the user. So on Facebook, we see that through the big ways through likes. But there's fan pages, there's comments on fan pages, there's likes. So there's the idea that you're doing something with the brand. You're engaging in something where the brand can get some kind of a reaction from you instead of just a click. And on Twitter, we see this quite a bit too. Because what you can do is you can follow a brand, which is, you begin to follow the brand based on what you've read from them. What we also see is that you can retweet something. So you're not only are you kind of following it, you're actually sending that piece of information or the link or the message out to your own followers. So you're kind of becoming an ambassador for the message, and so just a brand being the ambassador of the message. So what we think about this is that that's really the promise of social media, and that's why when we see engagement numbers that are a little bit lower than we had anticipated and that we had hoped, it has implications for social media at large. Over time, we do believe those engagement metrics are going to increase, and there is going to be an opportunity to have more ad spend geared towards social media with respect to the Facebooks and the Twitters of the world. There's a question here about the implications of Pandora's soft quarter last night. So let me reiterate a couple of things I mentioned about Pandora and then talk about what happened last night. So what really happened last night was that, a key part of our thesis, I think, continued to unfold last night. And our thesis on Pandora has long been the idea that mobile monetizes at a lower rate than desktop on a per-hour basis. And the reason for that is that Pandora is special in the sense that it is mostly an audio experience. You get things like putting when someone's listening to Pandora on their device, they put the device in their pocket. They're literally not looking at the device. And what that essentially means is that no one's going to pay for a visual ad. And the management commentary suggested that they're not going to pay for a visual ad. Almost all of their mobile advertising is done over audio only. And that's a real problem for them. And as more and more hours go towards mobile, everyone is moving towards the low ad side of the business instead of the high ad side of the business. And we saw that unfold last night. And that's really impacting, impacted the stock in the aftermarket last night and certainly impacting the stock today. Why we can't get increasingly constructive on Pandora is that we don't see a path to improving this over time. So even if they can improve engagement to a certain extent, we don't see this changing for them in terms of the mobile desktop ad per hour split, because it's primarily an audio service to begin with. There's a question here about thoughts on Yelp in the aftermarket. The company will not be profitable for some time according to current reports and pro forma projections. Do you believe there's a long-term growth possibility for Yelp? So look, we are actually positive on Yelp overall in terms of the business model. We obviously can see that it's not yet profitable, but we do expect them to inflect to profitability in 2013. We did believe there was upside from the IPO value. Our price target on Yelp is $19, so when they priced the IPO at $15, we felt there was some upside potential there. When it jumped to $24, we thought it got a little bit stretched a little bit quickly, which is kind of the what typically happens in the space when these companies IPO. And I think that what's happened is the valuation is pulled back a little, and it's come a little bit closer. It's around $20 or so now, so a little bit closer to our price target. So what I think is going to happen over the long term for Yelp is that I think it will grow into a higher valuation over time. I think it's kind of fairly priced right now, but overall I think that it's going to do very well. And the reason for that is they do two things better than anybody else. The first thing is reviews. And on the surface, it can sound like anyone can build a review platform and it's very easy to replicate. But the truth is, we don't think it's very easy to replicate. We actually think it's very difficult to replicate because they've invested in the reviewer community from day one. They built it as a social platform truly from the reviewer standpoint. You can follow a reviewer. You can chat with a reviewer. He puts his picture up. There's an interaction there. There's a social incentive that's based around it. They throw parties for the top reviewers in every city across the country. Not every city, the major cities across the country. You get an elite status if you're a top reviewer, and the elite status is displayed prominently for you as a reviewer. So you build up this social incentive. And if you look at what's happened, some of the academic studies that have come out of Harvard Business School and Northeastern University, you'll see that on average, Yelp reviewers tend to be more prolific and less extreme than other places like Yahoo Local and City Search. And there's a trust factor, therefore, that gets built into it. So they actually do reviews better than anyone else. The second thing they do better than anybody else is that they do mobile better than anyone else. They're a top 10 app, not just in the local space or the review space or the tech space or whatever. They're a top 10 app across the board on the iOS platform for many quarters that we've seen. So they do mobile better than anyone else. Their augmented reality application is excellent. The desktop transitions to the mobile very well. So I think this is going to do very well in terms of being able to drive local ad spend and national ad spend over time. So overall, look, we really like Yelp's business. We think they are a real disruptor in the mobile space. This question here about will there be a price war among ad networks? And I think that the implication here is that, or I guess the question is around whenever Google gets into one of these markets, they tend to underprice. Whether it's how much a handset maker has to pay for Android, or how much how much a vendor has to. The percentage economics that a vendor gets for daily deals, Google tends to underprice. So I think it's a very fair question. I don't think there's going to be a price war per se in the near term with respect to ad networks. The reason is that there's just so much noise right now that it's very difficult to understand. And this goes back to one of the big challenges, I think, that was happening in some of the big challenges that was happening from brands, because the brands were saying that we don't have standardized metrics, we don't have standardized measurement capabilities, so it's very difficult for us right now to understand the kind of inventory and the pricing that we're getting there. So I think that we're not going to see a price war per se, but I think what could happen over time is as standardization increases and we get a better sense of it for every dollar that you're spending. What exactly you're getting for that dollar, then I think we could see some more direct price comparisons between the two. Premium inventory versus remnant inventory, different things like that. To kind of which device you're going to get. Are you going to get with somebody like Android or with somebody like AdMob? Are you going to get a whole bunch of different devices? Or are you going to only get iPhones and iPads with iOSs? As all these things slowly get resolved, we'll have a better understanding of the differences in prices. But right now, there's just too much. There's too much noise in the marketplace right now. I'll take the last question. There's a couple of questions here in terms of millennial media. We are working on some more information around millennial media right now and taking a deep dive into it. Overall, I would say on an anecdotal basis, it has been received very well. I think people are very excited about this. I think it's going to be the first of several players to look to tap public markets in the online advertising space. What we're seeing right now is, and this goes to a broader commentary about display advertising, which is to say that display advertising is really moving down the purchase funnel. When we think about the way display advertising has been traditionally used online, it is that display advertising is mostly for brands. So when you need a lot of people to see your ad, you do a CPM-based brand advertising campaign. What you want to do is when you think that someone is closer to making an actual purchase of something, you tend to spend more on search advertising, because if someone is looking to purchase shoes, they might type shoes into a search engine, and then you want to buy AdWords against shoes or something like that, right? So it's a different type of advertising. What's happening right now is as audience measuring capabilities improve, you get more and more information about the user and get closer to that holy grail of figuring out what is user intent. And when you get closer to user intent, that's really where being able to deliver that audience to an advertiser is very valuable. And as those measurement capabilities improve, display becomes more and more relevant to the purchase-ready consumer. And that's something that is helping to push display advertising down the purchase funnel, away from pure brand advertising and towards purchase advertising. So really starting to get on search advertising's historical turf, so to speak. So overall, millennial media, I think there's a lot of excitement around it. I think it's going to be the first of many companies in this space that will be looking to go public. So millennial media on the ad network side, but there's going to be more companies as we think about different ways to parse data, to serve advertisers, to deliver audiences. Whether it's display side platforms, in the mix there, kind of solving that gap between advertisers and publishers, whether it's other kinds of networks, whether it's audience aggregation and measurement type companies. There's a lot of movement there taking place right now, and display advertising is really going to be coming to the forefront of not only the mobile side, but on the desktop side as well. So overall, anecdotally, I'd say that the people we've spoken to seem very excited about millennial media. I think overall, obviously it depends on what kind of valuations that we're talking about, but overall we expect it to receive, to get very good reception among investors and to be successful in its IPO. So again, I just wanted to take a moment and thank you very much for joining us. There's a lot more questions in the queue, and I'm sorry that we couldn't get to them all, but please feel free to follow up with us. We have the website and the Twitter and the email information all there. So again, the point is that we want to use these webinars on a monthly basis as the beginning of conversations, and we don't want to just be quote-unquote talking at you for an hour once a month. We want to use this as an opportunity to engage you, and hopefully you found this and our other webinars interesting, and we'd love to chat with you guys further. Whether you're an investor, whether you're someone in the space, whether you're a brand, whoever it is, we're always looking to learn more and to share our insights as well. So on behalf of the GreenCrest research team, I do want to thank you for your time today, and we hope to hear from you soon. Thanks a lot.